This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Inheritance tax is what's known as a capital tax. And it's not like any of the other taxes in this manual. It's not like any other taxes that you'll come across. It's very different. So it's very unique. And I have to say, it's actually my favourite tax. I know that sounds really strange for somebody to have a favourite tax, but I like this because I like the way it's logical, thoughtful, progressive, and I like the way it kind of to teach it and to learn it. There are a couple of things that I will explain really slowly because they are the concept of them is perhaps unusual to do. And you may find it necessary sometimes to pause the lecture and just to go through what I've said again, just to make sure, because it is different from anything else that you will have done before. So one of the basics, to be within the scope of IHT, there must be a transfer of value of a chargeable property by a chargeable person. One of the key things with inheritance tax is to make sure you use the correct terminology. The examiner, the marker of the exam, is looking for use of this correct terminology. So please learn the rules, but also learn the terms and make sure that you can spell some of them correctly, because some of them have a little bit of an unusual spelling to them. So let's look at these individually. Firstly, let's look at what is a transfer of value. Now, it says there that IHT is a cumulative donor-based tax. In other words, the person who is giving away the assets, the money, the shares, the building, the land, the jewels, it's based on them and it's cumulative, so it all adds up together. So an individual must make a transfer of value, and what happens is that gift will decrease or diminish the value of their estate. Now this loss to the donor principle is known as diminution. D-I-M-I-N-U-T-I-O-N. Please spell it correctly. Okay, it's the loss to the donor principle. In other words, it's what I have lost as a result, not what I gave away, but what I lost. Now this includes lifetime transfers, so I can give things away during my lifetime, or what I leave when I die in my estate. Now, the amount of tax that may be payable, it's not always payable, on that gift is based on what they have paid in the previous 7 years. That's why it's called a cumulative tax. It's based on a 7-year period. Now, one of the things that we need to look at with this diminution, and this could come up as a multiple choice question, or it might come up as a valuation to go in, say, a section C question, section B or C question. Okay. Inheritance tax will probably come up it will come up in either a B or a C section question on its own. Sometimes it's linked with capital gains, but sometimes it can come up on its own as a full question. Normally for 10 marks rather than 15, I wouldn't have thought, because there are bigger questions that they need to ask that would cover the 15 marks, particularly adjusting profits, capital allowances, capital gains, that sort of thing. So let's look at diminution. Give you an illustration. A owns 60% of the shares in A Limited. There are 100,000 of those shares in issue. So they've got a 60% holding. They've got 60,000 shares. Now the share valuations agreed by the revenue are as follows. Compute or work out the transfer of value if A were to die leaving his shares to his daughter, or alternatively, if he was to make a lifetime gift of 200,000 of those shares, 20,000 of those shares to his daughter. So we've got two things. What happens when he dies, when all the shares are transferred, or alternatively, if he makes a lifetime gift of 20,000 shares. So let's have a look. If A dies owning 60,000 shares, which is a 60% holding, they're valued at £25 per share, giving a value of £1.5 million, which would be included in the death estate, which we will deal with later. So you may have to do a valuation like that in order to include something into a death estate. This is a lifetime, so that happens when on death. This is a lifetime transfer. He's giving away 20,000. The transfer of value isn't based on that 20% value as it would be for capital gains tax. What we have to do is work out the difference between what did he have before, which was a 60% holding, and what does he have afterwards. What has he lost? Not what's he given away, what has he lost? The loss to the donor principle diminution. So this calculation will get you marks in an exam. So if you've got to do a diminution calculation to work out a transfer of value, then you need to know what did he hold before, which was a 60% holding valued at £25 per share, which we worked out to be 1.5 million. Afterwards, he's only got a 40% holding. Now the value has dropped because he's no longer got control. And the £15 per share value on 40,000 shares is 600,000. So he has lost his estate, his valuation, his assets are now £900,000 less than they were before. That's the diminution. Diminution, the loss to the donor. Principle. Okay, so that's what a transfer of value is, and you will have to calculate probably one of those in an exam. Chargeable property is anything that you own that you are beneficially entitled to, and the individuals that you're only going to have to deal with individuals. You're not going to have to deal with trusts at this level. Advanced tax, yes, but not this level. So if you are domiciled in the UK, then it's anything worldwide. If you are not domiciled, then you only pay IHT on your UK assets. So we are looking now at lifetime transfers, just at gifts that are being given during somebody's lifetime. They've decided to transfer some assets. Now, there are three types of lifetime transfer. There are exempt transfers, where there is no IHT at the point. Okay, and there are various reasons why we'll look at later. Two, potentially exempt. In other words, they're not exempt yet, but potentially they could be. Now, this is a gift. It must be individual to individual. At the time the gift is made, there is no IHT. Now, if the donor, me, if I live 7 years after giving that gift, it becomes exempt and there is no IHT charged. However, should I die as the donor, if I die within 7 years, then that pet becomes chargeable. Now in the exam, just one thing. The first time you come across this, I call them pets because that's what they are. You must write out in full potentially exempt transfers. Write that out in full, brackets pets, close brackets, then you can use the pets small instead. But you must write it out the first time so the examiner knows that you know what it means. Pets, individual to individual, No IHT at the time. You live 7 years, it becomes exempt. You die within 7 years, it becomes chargeable. The third one, chargeable lifetime transfers. Again, write it out in full before you do brackets CLT. Okay, it will always be a transfer into a trust. Always. Now, there are taxes due at the time the gift is made at the lifetime rates. And again, you will pay tax at the time of death if you die within 7 years. Now, the rates, as always, are at the front of your exam or the front of your manual, any test paper that you take. There are some other exemptions which are available on these lifetime gifts. First one is the annual exemption. Please get these annuals exemptions correct. Income tax, it's called a personal allowance. Capital gains tax, it's called an annual exempt amount. This is called an annual exemption. Please get them correct. Okay, it will be given to you in the exam, but it is £3,000 each year of any gift is exempt. Now, any unused, you can carry it forward 1 year, 1 tax year. If you've got several gifts, you do them in the order in which they come. And obviously, the first one will take the annual exemptions, and then the second one probably won't. The marriage exemption. So, you make a gift to somebody on the occasion of their marriage or civil partnership. There are some limits. Now, you've got to learn these. They're not in the rates. If you are a parent of the bride or the groom, it's £5,000. If you are a grandparent, it's 2.5. Anybody else, it's £1,000. So the annual exemption is done afterwards. So you do the marriage exemption first, if it's applicable, and then the annual exemption, because the annual exemption, if unused, can be transferred to the next year, and the marriage must take place. Now, these are the fully exempt transfers. Do you remember at the beginning here we said that there were 3 types? The exempt transfers, there are 3 types. And if you look down the page, you'll see them. They are the transfers between spouses and civil partners. Now, they're exempt. Again, this situation arises for capital gains tax. Now, in that situation, it's a no gain, no loss transfer. This is an exempt transfer. Please make sure you get the correct terminology with the correct tax. So for CGT, it's no gain, no loss. For IHT, it's exempt. Small gifts. Gifts up to £250 per donee per tax year are exempt. If you give a gift of £200, it would be covered by that exemption. If you give a gift of £300, you don't get £250 knocked off and only pay tax on the balance. It's above the limit. And then normal expenditure out of income. The donor must show a regular pattern of giving and must have enough income left to retain their normal standard of living. That's really, really important. So these exemptions, let's have a look with this illustration. This is a typical kind of question that you could get further into the exam, section C, section B or section C. We have to compute or work out the chargeable transfer, okay, not the transfer of value, the chargeable transfer after we've taken all the exemptions off for each of the following lifetime transfers. First thing you do when you work all of these things out is to work out whether there are any exempt transfers in there. All right. 7th of June 2021, a gift to her daughter. That would be a pet. A wedding gift to her son in August. That is also a pet, but then we've got the marriage exemption that we could deal with. A gift to her husband. That is exempt. Gift to her nephew. That's also a pet with a marriage exemption. Ooh, small gifts potentially. Let's have a look. And a gift to a trust, that's a CLT. So, always write out the rules and make sure you include all the dates. So the gift on the 19th of September, we've decided, yep, that was exempt. We got that one. The gifts on the 25th of December, they are also covered by that exemption because they are small gifts. There are 3 pets and 1 CLT. Sometimes it's worth writing those out. Obviously, I've just made a note next to them, but if you can do that every time, just get into the habit of, what is this gift? Is it a pet? Is it exempt? Is it CLT? It's the sort of thing you kind of just get used to doing it every time. Is it group? Is it a pet? Is it a exempt? Is it a CLT? Now, this is the way that we calculate all of these. You put the date at the top and then what kind of gift it is. Can you see that? We've actually said that. Now, there are half marks for that. Please get them by stating the obvious. I've seen this is a pet. You'll get half marks for those sort of things. The transfers of values have come from the questions, and then we have a list of exemptions. So this is the typical pro forma that we're going to use in this chapter. You get the annual exemption for the year. So the gift in the 7th of June is in the year 21-22. It is covered by the annual exemption, and therefore there is no tax to pay. Don't forget the balance can be carried forward 1 year, but is always used after the balance from the current year. Now, this is in the same tax year because it's only 2 months later. That's the transfer of value from the question. Now, the marriage exemption comes first before the annual exemption. We only need another £500. Again, no tax. So that was in 21-22. This one is in 22-23, in July 22-23, and so is this one. So the pet from the question, the marriage exemption is reduced dramatically because it's only, was it a niece, nephew? Nephew. Remoter ancestor. Okay, that's a remoter ancestor. Let me write that on there so you can see. A remoter ancestor. So it's only £1,000. We have the annual exemption for the current year, which is always put in first. Then any balance brought forward which has been unused. And we only have 500 left of that. So this would be the gross chargeable transfer. The following gift is a CLT, £100,000 into a trust. No exemptions, all the exemptions have been used. All the exemptions have been used. And that then is taxable. This is potentially exempt. And we're going to see later what we do in that situation.